This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Late day drop. The Bears come out in force minutes before the closing bell, throwing what had been a relatively calm day into a tizzy.
I'll scratch your back if you scratch mine. How pervasive is that behavior that forced the CEO of United Continental to resign throughout the rest of the business world?
And what slowdown? Why the faltering of the Chinese economy could actually be a positive for the United States. All that and more tonight on Nightly Business Report for Wednesday, September 9th.
Good evening, everyone, and welcome. Late day drama, which saw the markets go deeper into reverse and swing 400 points. The day started with a spark when stocks bounced right out of the gate, but that's pretty much where it ended. And the rally started fading shortly after the release of a strong government report on the labor market. So strong that some say it could prompt the Federal Reserve to raise interest rates for the first time in nearly a decade. They meet next week. Combine that with the continued uncertainty in the market, and stocks fell even harder into the close. By the end of the trading day, the Dow Jones Industrial Average dropped 239 points to 16,253. All 30 Dow components finished lower. The Nasdaq declined 55. The S&P 500 was off 27. Oil certainly didn't help either. West Texas Intermediate fell 4% to 44.15, and that pressured energy shares. So Mary Thompson was right in the middle of that, today's action at the New York Stock Exchange.
Another volatile day on Wall Street. The intraday swing in the Dow, 400-plus points. The Dow opening up over 170 points in early trading, following the gains that we saw in Japan and China. The big gains there spurred by repeated promises of lower corporate taxes in Japan and more government stimulus in China. However, that wasn't new news, and that made traders skeptical the rally could hold here in the U.S., especially following Tuesday's big gains. Well, the U.S. markets were then hit by a report on job openings about 10 Eastern, and that report said that openings are at their highest levels in 15 years. The so-called JOLTS report causing the markets to start to sell off in early trading. That's because it raised expectations that the latest sign of strength in the U.S. labor market could give the Federal Reserve another reason to raise interest rates, possibly as soon as next week when policymakers meet. The market slide accelerating late in the day when Apple's announcements of a new iPad, updates to Apple TV, and new iPhones failed to send shares of the tech giant higher, adding weakness in energy stocks on the back of another down session for oil. And the Dow finished off more than 230 points and back in correction territory. From the New York Stock Exchange, I'm Mary Thompson for Nightly Business Report.
The promise of more stimulus out of China had U.S. investors cheering early on today, but in reality, the U.S. may be the country least affected by what's going on over in China. Now, that may sound counterintuitive since the global economy is so interconnected and China is the world's second largest economy. But that theory has been backed by recent reports, and as Steve Leisman explains, a slowdown in China may not necessarily pose a big threat here in the U.S.
Much of the market volatility has been tied to concern over China's economic slowdown. But to several economists, it looks like the tail wagging the dog. The U.S. buys about 5 times more stuff from China than it buys from us. That means China is far more dependent on U.S. growth than the other way around. In fact, total trade, imports and exports, is only about 3% of the $17 trillion U.S. economy.
When China slows down, it tends to have ripple effects, of course, on the whole region in Asia and also emerging markets more broadly. But when you quantify the impact of a 1% decline in slowdown in China, it only has a 0.1% impact on U.S. GDP. So that means that the impact on the U.S. overall, both direct and indirect effects, is actually very limited.
A recent study of 27 countries found the U.S. among the least vulnerable to a sharp Chinese slowdown. Commodity sellers like Argentina and Russia would fare the worst. Still, some sound the alarm bells. They note that U.S. corporate profits, as opposed to the overall U.S. economy, will suffer because Chinese consumers buy less from American companies. They add that China is so ingrained into the world that a cooling of the Chinese economic dragon will spread a chill felt in the U.S.
For the US, clearly, domestic demand is much more important than external demand. The rest of the world does, however, have an impact, and unless you compensate for that, you do worse. The notion that the US can drag the global economy along, it's no longer the case.
Yet, a recent study by economists at the Kansas City Federal Reserve Bank found a new upside for the U.S. from a Chinese slowdown. Tens of billions of dollars are now leaving the country and ending up in the U.S. economy. From condos to companies, the Chinese are buying U.S. assets, helping prop up real estate and equity prices. So far, the data back up the optimists. As China's economy has slowed, the U.S. economy has actually accelerated, suggesting that while the U.S. economy's fate is affected by China, it's not ultimately determined by it. For Nightly Business Report, I'm Steve Leisman.
But widely followed hedge fund manager Jim Chanos remains bearish on China. In an interview today, Chanos said Chinese economic growth would continue to decline by about 2% a year. And he made it clear that he thinks the Chinese economic model of heavy investment is broken.
Investment is still almost 50% of the economy. And they're running out of room to borrow. That's the real problem. The banking system is loaned up. They've had to resort to shadow banking. And now capital is leaving. And that's the real sort of news story.
Chanos is the founder and president of Kinnikos Associates with more than $3 billion in assets under management.
The Chinese government reportedly invited BlackRock CEO Larry Fink to discuss the prolonged slide in the Chinese stock market. According to CNBC, Fink accepted the invitation and traveled to China late in August to meet with officials there. BlackRock is the world's largest asset manager.
Now to the scandal in the sky. As we reported last night, United Continental's chief executive and 2 other company officials resigned amid an ongoing federal investigation. Now the public and investors are asking what went wrong at United. It's a question that faces United's new CEO, who vows to lift the airline to new heights. Phil LeBeau has the story.
A corporate scandal rocking an airline struggling to get its act together. Jeff Smisek, chairman and CEO of United Airlines, resigned without warning as questions mount about the relationship he and 2 United executives had with the former head of the New York, New Jersey Port Authority, which runs the Newark Airport. Federal investigators are looking into why United added flights from Newark to Columbia, South Carolina, near a second home of the Port Authority leader, a route later canceled when the Port Authority chairman left his job. Did United add the South Carolina flights to improve its lease at Newark?
The issue of, is there something of value, was there a quid pro quo, or is there a kickback?
United is not commenting on the investigation. Meanwhile, its new CEO vows to improve the airline's performance. From a poor on-time arrival record to lackluster scores in customer satisfaction, United can do better, and the airline's new CEO knows it.
It's just an absolute and complete point that we need to reach our customers with a better service product. And we need to just convince them that that is our commitment. And that's just going to take a lot of time and effort.
Munoz takes over United after running operations for the rail giant CSX. Given his background, analysts are cautiously optimistic Munoz can lift United to a level of profitability and performance that matches the airline's top competitors. Phil LeBeau, Nightly Business Report, Chicago.
So how pervasive are trading favors in the business world? John Singer is a partner at the New York law firm of Singer Deutsch, and he joins us now. Mr. Singer, welcome. We don't know all of the details of what transpired between the folks from United and the former head of the Port Authority of New York. But one can well imagine that favors often get exchanged, whether they're asked for or just given without being asked for. Where is the line drawn between what is acceptable business practice, acceptable especially in the context of a government official, and what crosses the line?
Well, I think in this case, I mean, you're dealing with a public entity. The Port Authority is controlled by New York and New Jersey, by Cuomo and by Christie. So you're dealing with taxpayer funds, and I think in this case, it was a pretty cavalier and brazen quid pro quo in the sense that there were these private flights to South Carolina from Newark that did not exist previously, and then all of a sudden, within a few days subsequent to the CEO of the Port Authority leaving, that flight was curtailed. And then, of course, that was the quid. Then the pro quo was United wanted to curry favor with the Port Authority, and they wanted lesser fees. They wanted improvement to the terminal. So it's really a classic quid pro quo, and one that was really a very cavalier and brazen one here.
This is obviously a different situation, though, from a private company. So how pervasive is that type of behavior with either publicly held companies that are doing business between another publicly held companies or private companies?
Sure. I think in the investment banking arena and the securities industry, which is my area of practice, it's quite pervasive. Where it crosses the line from permissible into impermissible, and then the impermissible arena would draw the ire of the regulators, is when you have shareholders being affected. So, for example, this whole harkened back to what happened in the early 2000s when you had some of the investment banks like Solomon Smith Barney and others, and you had Jack Grubman writing research reports that did not reflect his true beliefs, but he would inflate ratings to curry the favors of the CEOs, and then in turn his firm would then garner increased investment banking fees. That, of course, affected shareholders because folks would rely upon those ratings. They believed they were true and that they reflected the true beliefs of Mr. Grubman and others. And then, of course, you had shareholders being affected, and then all of a sudden the state securities commissioners and the NASD and the stock exchange got involved.
Is it ever okay in the case where a private company is doing business or negotiating with a public entity like the Port Authority, is it ever okay for that public company to do something that it knows benefits the private interest of an individual at that public entity that they're doing business with, even if that individual has never asked for it? In other words, can I do you a favor that you've not asked for just because I know it'll make you happy? Is that wrong? Is that out of bounds too?
Well, I think that's getting into a little more of the gray area. I think that people act a certain way so that they think they could affect change and maybe benefit someone. But I think in this case, you had the public figure in this case, Sampson, who was the CEO of the Port Authority. He was benefiting personally.
Correct.
The taxpayers weren't benefiting. He was the one who was flying to his second home in South Carolina. So he was going to personally benefit, but I'm not sure how anybody else was going to benefit from that. Now, the question is whether United did anything improperly. I think United concluded that their CEO did not, because I think he walked away with $4.9 million as a separation package. So they did not terminate him for cause. If they had done so, then they would have clawed back
all of that. Right.
Exactly. I think that he was doing a proper thing for the United shareholders, because shareholders would benefit if fees were lower for United and if the terminal was better. I think the wrongdoing here was effectuated on the part of the CEO of the Port Authority, not on behalf of United.
Okay. John Singer of Singer Deutsch, we appreciate your time tonight.
Thank you very much.
Still ahead, the sector of the economy that's having a hard time filling positions, and it's likely not the one you think.
A new survey says the wealth gap in the United States is a bigger problem for the economy ultimately than slow growth is. According to Harvard Business School's survey of its alumni, inequality poses a growing threat to U.S. competitiveness. Two-thirds of the respondents say addressing middle-class stagnation should be a higher priority than increasing overall economic growth.
Boosting economic growth, however, is a key issue for Republican voters. And today, Republican presidential candidate Jeb Bush outlined his plan to rev up the economy. And it all comes down to taxes. John Harwood has the details on how it compares to the plans of the other presidential hopefuls.
Businessman Donald Trump!
Trying to emerge from the shadow of Donald Trump, Republican presidential candidates are turning to taxes. Today, it was former Florida Governor Jeb Bush who proposed a sweeping reform to slash personal and corporate rates.
The difference between 2% and 4% growth is this. At 2%, we'll stay where we are, with millions on the sidelines falling behind. At 4% growth, we grow at a pace that lifts up everybody, and there's no excuse for not trying. We need to jumpstart our economy. And we can do that by fixing our broken tax code.
Other Republicans have outlined tax reforms as well, but the plans diverge on key details. On top rates, Marco Rubio stops at 35%. Bush goes to 28%. And Rand Paul has a 14.5% flat tax. On corporate rates, Rubio goes to 25%, Bush drops it further to 20%, and Paul would institute a 14.5% value-added tax. On investment income, Bush goes to 20%, Paul applies his flat tax, and Rubio would eliminate capital gains and dividend taxes altogether. Two big questions they all face: how much would their plans increase the budget deficit, and how much of a windfall would they provide to the wealthy? Two more questions: what sort of plans will we get from Hillary Clinton and Donald Trump, neither of whom has offered full proposals so far? For Nightly Business Report, I'm John Harwood at the White House.
More now on that labor report we mentioned earlier in the program. The government says there were nearly 6 million job openings in July, the highest ever. But even though companies are hiring, the Secretary of Labor says there's still room for improvement.
There's still slack in this economy. We can still do better in terms of lowering the unemployment rate. And one of the best ways to put that upward pressure on wages is to have even more tightening in the labor market. And so I think there's opportunity to do that. We're not done yet. I'm pleased with this report, but no one's spiking the football. We got more work to do.
Well, despite the rise in job openings, hiring fell from the prior month, meaning companies are having trouble filling the positions.
And one industry that's having a hard time filling positions is fast food. So Chipotle is making a big recruitment push following a number of moves taken by other fast food companies to hire and retain employees. Morgan Brennan has the story from Rye Brook, New York.
Chipotle went on a hiring spree, opening restaurants 3 hours early this morning to interview job seekers.
I would love to work at Chipotle because I love Chipotle, and of course you get free food. I don't know. Chipotle is it's a good place to work at. It's better than most fast food places.
The goal? Hire 4,000 workers in a single day, a move that would boost the company's 60,000 person workforce by nearly 7%. Some of that will staff the roughly 200 new restaurants opening this year. But Chipotle says many of those hires will actually fill open positions in its nearly 1,900 existing restaurants. The fast casual burrito chain promoted its hiring blitz on social media sites and music streaming service Pandora, with each location prepared to interview as many as 60 applicants. Analysts say it's a good move for the company.
Having the extra help during these peak periods will help get more customers in through the door. So ultimately it will help Chipotle be a winner in this situation.
The hiring binge is just the latest example of a growing trend in the fast food business, a tightening labor market. As the economy picks up and more people eat out, fewer workers are applying for jobs at Chipotle and other restaurant chains. Companies are responding. Earlier this summer, Chipotle beefed up its benefits packages with college tuition reimbursement for hourly employees, more paid vacation and paid sick days. The Cheesecake Factory and McDonald's corporate-owned restaurants recently hiked pay, above and beyond markets where the minimum wage has increased. Starbucks is providing tuition reimbursement and financial aid to staffers who enroll in an online bachelor's degree program. And Buffalo Wild Wings says it will raise wages faster than competitors to hang on to more workers. It calls the availability of labor one of its biggest headwinds.
It costs less to retain his employees through higher wages and benefits rather than to go out and recruit new employees and train them. So ultimately, yes, it's a problem for the restaurant sector, but in our view, given continued sales growth, it's a high-quality problem to have.
As for Chipotle, was there enough activity to fill 4,000 positions? Well, this Westchester County, New York location did welcome a handful of hopefuls and did do some hiring on the spot. Overall, Chipotle says it had 60,000 applicants pre-register for today, more than the company had hoped for, meaning that while the labor market may be tightening, there are still many that like what this company is cooking up. For Nightly Business Report, I'm Morgan Brennan in Rye Brook, New York.
Well, even though the labor market is tightening just a bit, not every company is hiring. No siree. Lockheed Martin eliminating 500 jobs in its Information and Government Services division. The defense contractor says the job cuts are in response to changing government priorities, and it comes a month after announcing the purchase of Sikorsky, the maker of the Black Hawk helicopter.
Another weak report from Barnes & Noble is where we begin tonight's market focus. The bookstore chain posted sales that fell for the fifth straight quarter and a fiscal first quarter loss that widened to $35 million. Decreased demand for its Nook e-reader, tablets, and online books weighed on its results. Shares slid more than 27% to $11.80. Krispy Kreme posted late earnings that disappointed. The donut chain missed estimates on both the top and bottom lines. And on top of that, its full-year earnings guidance was weak. The company says its results were hit by weaker than expected demand for its packaged goods. Shares slipped in initial after-hours trading. Before the close, the stock was off a fraction to $17.73. Opposite story, though, for Box. The cloud storage company posted a loss that was smaller than anticipated and a revenue beat as more customers subscribed to its service. Its third quarter guidance was also better than predicted. Shares were higher right after the close. Shares ended the regular session up 2.5% to $14.25. And Palo Alto Networks posted quarterlies that beat on the top and bottom line. It also gave strong first quarter guidance. This as companies and governments are spending more to protect themselves from cyber attacks. Shares popped in initial after-hours trading. At the close, the stock was off slightly to $165.17. Ty?
CSX Railroad announced today that weak coal demand will weigh on its results next year. The firm says it's going to be difficult to meet its profit goals, and it expects small full-year bottom-line growth. Shares were off today a fraction at $27.81. Meantime, XPO Logistics buying the trucking company Conway in a deal worth $3 billion. The combination will increase XPO's revenue to $15 billion. This according to that firm. Shares spiked in initial after-hours trading, as you see right there. Before the close, the stock was off about 2% to $35.53. And McDonald's is switching to cage-free eggs in the United States and Canada. It's going to take them a long time to get there, though. It's going to take a full decade to go 100% cage-free. This comes a few months after the fast food chain announced it will stop using chickens raised with certain antibiotics at its U.S. restaurants. Shares of Mickey D's off more than 1%, cage-free or not, at $95.43.
As we've been reporting, a new class of injectable cholesterol-lowering drugs have just been approved by regulators. But according to a new study, the treatments are too expensive. A nonprofit that evaluates the cost-effectiveness of new medicines says Regeneron, Sanofi, and Amgen's new treatments will cost about $14,000 a year per patient, but they should cost about $2,200 per patient.
Coming up, Apple unveiled new devices at a big event in San Francisco, but will it be enough to reverse the doldrums in the stock?
Here's a look at what to watch for tomorrow. We get weekly jobless claims. Import and export prices are out. They're an important gauge of inflation. And the report on wholesale trade is out as well. That's what to watch for Thursday.
And finally tonight, Apple introduced the world to a slew of new iGadgets at its highly anticipated event today. But investors, well, they didn't seem highly impressed. Shares slipped about 2%. So what's new and what failed to wow Wall Street? Josh Lipton sums it up from San Francisco.
We are about to make some monster announcements across several of our product lines.
A play for dominance in your living room, a big step into enterprise, and an under-the-hood upgrade on your wrist and in your hand, all unveiled Wednesday afternoon in San Francisco as Apple gears up for the key holiday shopping season amid a sliding stock price and investor concerns about a slowdown in iPhone sales. One of the big worries, China. But Cook announcing on stage that the company saw 75% year-over-year iPhone sales growth there. The iPhone 6s and 6s Plus featuring enhanced camera and video capabilities along with 3D Touch, which is a new way to multitask on the phones in a more fluid way. Apple also announcing a new pricing and upgrade plan. Pay $32 a month and upgrade phones every year. But will the iPhone refresh and pricing plan ease investor concerns about the stock?
You have less than 30% of customers that have upgraded to 6, and this is really now going to be the catalyst. And I think it's a prove me situation, a white knuckle situation, but they've laid out that product roadmap on iPhones, on Apple TV, on the iPads. I feel like you walk away from here incrementally confident.
Much of the attention focused on the refresh of Apple TV, 3 years in the making. Cook says the new set-top box addresses the needs of the next generation of mobile and at-home viewing.
We believe the future of television is apps. In fact, this transition has already begun.
The new Apple TV will include its own operating system. It also integrates Siri into a new remote and will allow you to shop and play games. And like all products announced today, will be available at some point over the next 2 months. From the living room to the conference room, Apple also introduced a new iPad Pro. A 12.9-inch device, Cook says, is Apple's clearest expression of personal computing. A clear play for the enterprise space and reminiscent of Microsoft's Surface tablets, it comes with an optional keyboard and stylus called the Apple Pencil, a product Steve Jobs famously hated. But if the Pro re-energizes sales that have plateaued for the iPad recently, there could be a lot to like for investors. For Nightly Business Report, I'm Josh Lipton in San Francisco.
And that does it for Nightly Business Report for tonight. Thanks for joining us.
And thanks from me as well. I'm Tyler Mathisen. Have a great evening, everybody, and we'll hope to see you right here tomorrow night.